Monetary policy, let's talk. It is a tool to manage money supply and interest rates in an economy. This is done to achieve macroeconomic objectives such as controlling the inflation, improving growth. The central bank is actually in charge of formulating and implementing the monetary policy. The first function is to stabilize the prices so the inflation will be refrained. Creating an environment that suits the investors, the people will have more savings and they will be able to invest more. The economic cycle will be rich. Monetary policy is also used to manage the demand and supply of the foreign currency. The central bank can also ensure the amount of currency for foreign currency in the market. There might be other objectives as well, for example, financial inclusion promotion. Financial inclusion means to promote the banking products and make the people aware about them. So let us talk about the tools of monetary policy. In this, central bank buys or sells government securities in the open market to inject or withdraw liquidity from the system. When they want to increase the supply of money in the system, they buy securities from commercial bank. When I am saying they, I mean central bank. Conversely, when they want to decrease the supply of money, they will sell the securities to commercial banks. The second tool is reserve requirement. This involves three things: CRR, SLR, and loans. Number one, cash reserve ratio. Central bank takes from commercial bank a certain amount, 5%. Whenever commercial banks faced a financial difficulty, this amount is used to rescue them. SLR, statutory liquidity ratio. Commercial bank take it for the purpose of paybacks of loans, paybacks of the amount that people have deposited in those banks. SLR is 15%. Remember, 5% is cash reserve ratio, 15% is SLR ratio. The rest of the 80% are the capital used by the banks, and they grant loans and earn interest on that. In case of inflation, both of these SLR and CRR, they are increased to reduce the amount of money in the system. By changing the interest rate, the central bank can encourage or discourage lending by commercial banks, thereby affecting the money supply and interest rates in the economy. In case of high inflation, central bank will increase the amount of interest rates so the lending will be minimized. To increase the supply of money in the market, central bank may go for printing of new notes. To increase the supply of money in the market, central bank may go for printing of new notes. In case of inflation, they will go otherwise and decrease the amount of printing.